The index fund, the boring investment that quietly beats the professionals. This is Ben. You met him in video number 3. He's the guy who quietly built $100,000 by 25 on a normal salary. This is a professional fund manager. He works for a major Wall Street firm. He has an MBA, a Bloomberg terminal, a team of analysts, and access to information most people will never see. He gets paid $400,000 a year to pick stocks. Over the last 15 years, Ben's investment, the one Ben spends 0 minutes per week thinking about, has quietly outperformed this fund manager. And this is not because Ben is a genius. Ben is not a genius. Ben does not even like investing. Ben bought one specific kind of investment on purpose and never touched it again. And in doing so, he joined the most boring, most powerful, most quietly successful investing strategy of the modern era. It's called an index fund. And the people on Wall Street do not love that you're about to learn how it works. The index fund, the boring investment that quietly beats the professionals. By the end of this video, you'll understand exactly what Ben bought, exactly why it works, and the one specific mistake new investors make that quietly costs them tens of thousands of dollars over a lifetime. What an index fund actually is. Let's strip the jargon off this thing first. Forget the word fund. Forget anything you've heard on financial TV. Here is what an index fund actually is. A regular stock means you own a piece of one company. If you buy a share of Apple, you own a tiny sliver of Apple. If Apple does well, you do well. If Apple has a bad decade, you have a bad decade. Your fortune is tied to one company, which is exciting and also terrifying. An index fund, instead, is a basket. When you buy one share of an S&P 500 index fund, you are not buying one company. You are buying a tiny sliver of the 500 largest companies in America all at once. Apple, Microsoft, Amazon, JP Morgan, Johnson & Johnson, Coca-Cola, Tesla, and so on. One purchase. Hundreds of companies. An index fund is not a bet on a winner. It's a bet that the overall economy keeps growing, which over long periods it has. This single design choice changes everything, because here's what it means in practice. If one of those 500 companies has a terrible year or even goes bankrupt, your investment barely notices. Its slice was tiny. The other 499 keep doing their thing. You don't need to be right about any single company. You just need to be right about the broad direction of the economy as a whole. And here is the part that most people don't know. The word index comes from the fact that the fund is just quietly tracking a famous list called an index. The S&P 500 is a list of the 500 largest American public companies. The total stock market index is a list of essentially every public American company. The MSCI World Index is a list of large companies across all developed countries on Earth. Each index is just a list. The fund's only job is to own the companies on that list in roughly the proportions they sit on the list. No genius required, no predictions, no analysts in suits. Just follow the list. This is why index funds are sometimes called passive investing, because the fund manager is not actively trying to pick winners. He or she is just following a rule. Buy what's on the list, sell what falls off the list. That's it. And the radical, counterintuitive truth this video is about to defend is that this boring, robotic, rule-following approach has, decade after decade, beaten the vast majority of expensively paid humans trying to do it the smart way. Why it beats the professionals. Now, this is the part most people refuse to believe. So let's slow down. There is an entire industry of professional fund managers, smart, credentialed, hard-working people whose entire job is to beat the index, to pick the stocks that will outperform the average. They charge fees for this service, typically about 1% of your money per year, sometimes more. The promise is simple: pay us and we'll do better than the boring index. Here's what the actual data measured over decades shows. The S&P indices versus active research, also known as the SPIVA report, has been tracking this question for over 20 years. The result is so consistent, it's almost embarrassing. Over any 15 to 20 year period, roughly 85 to 90% of professional US stock pickers failed to beat the simple S&P 500 index they were paid to outperform. Read that again. Not 50%, not 60%, around 85 to 90%. The overwhelming majority of paid experts with full-time staff and expensive software lose to a strategy a robot could run. So why does this happen? 3 reasons, and each one is worth understanding. Reason 1: fees eat everything. Even if a professional manager picks great stocks, that 1% annual fee compounds against you, exactly the way we covered in the compound interest video. A manager who matches the market but charges 1% per year ends up roughly 20% behind the index over 30 years just from fees. To beat the index, they have to beat it and overcome their own fee. Most can't. Reason 2: the market is already very smart. Here's a truth that took economists decades to fully accept. The stock market is not full of dummies. It is full of millions of smart, well-funded people, all trying to find bargains at the same time. By the time you read news about a company in the Wall Street Journal, thousands of professionals have already traded on that information. The price has already adjusted. You are very rarely the first one to know anything. So picking individual stocks isn't competing against the market. It's competing against millions of full-time analysts who saw the same headlines before you did. The index sidesteps this entire fight by simply owning everything. Reason 3: even pros are human. Even brilliant fund managers panic during crashes. They sell low, they chase trends, they get fired if they don't deliver short-term returns, so they make short-term decisions. The boring, rules-following index fund has no emotions. It just keeps buying what's on the list. In a market that punishes panic, robotic discipline wins. This is why, over the long term, the dumb, boring, robotic approach beats the smart, sweaty, expensive one, not by luck, by design. The one number that quietly eats you: fees. Now, here's where most new investors quietly bleed out without realizing it. So let's talk about fees, because this is the one number you absolutely must look at before you ever invest $1. The fee on an investment fund is called the expense ratio. It's expressed as a percentage of your total invested money charged every year automatically by the fund, whether the fund makes money or loses money. A good index fund typically charges between 0.02% and 0.10% per year. We're talking pennies on every $100. Some excellent funds from Fidelity, Schwab, and Vanguard charge literally zero, or essentially zero. A typical actively managed fund, the kind your friend's uncle, who's a financial advisor, might recommend, typically charges between 0.50% and 1.50% per year, sometimes more. That sounds like a tiny difference. It is not. Same $200 a month, same market, same 40 years. The 0.03% fund, roughly $1.4 million at the end. The 1.00% fund, roughly $1.05 million. The fee difference, barely 8%, quietly costs you about $350,000 of your retirement. The single most important number on any investment fund you buy is the expense ratio. If you only ever check one thing, check this. And here is the part that should make you furious. Many of those high-fee funds, the ones charging 1% a year, do not perform any better than the cheap ones charging almost nothing. Often they perform worse because the fee itself drags them down. You are not paying the higher fee for better results. You are paying it for, in many cases, no benefit at all, often just for the privilege of having someone manage the account who has a nicer office. Ben's index fund charges about 0.03%. He never paid for a financial advisor to manage it. The fund essentially runs itself. And that single design choice, choosing the lowest fee fund he could find that tracked a broad market index, is one of the most important financial decisions he ever made. The types you'll actually encounter when you go to open a brokerage account, you'll be greeted by what feels like an overwhelming menu of options. Don't panic. For 90% of beginners, you only need to understand 3 categories. We'll cover all 3 quickly. Category 1, the Total Market Index Fund. This is the broadest possible single index fund. It owns essentially every publicly traded U.S. company, thousands of them. If the American economy grows, so does your investment. Examples: Fidelity, Total Market; Schwab, Total Stock Market; Vanguard, Total Stock Market. Fee, typically 0.03% or lower. This is the closest thing to just buy America in one click. Category 2, the S&P 500 Index Fund. This one tracks just the 500 largest American companies, slightly less diversified than the Total Market Fund because it skips small and mid-sized companies, but historically nearly identical performance. This is the most famous index fund category in the world. Examples: Fidelity 500 Index, Schwab S&P 500 Index, Vanguard S&P 500 ETF. Fee, typically 0.03% or lower. Category 3, the Target Date Index Fund. This is the most beginner-friendly option and the one most retirement accounts default to. You pick the year closest to when you'll retire, say 2065, and the fund automatically holds a mix of stock index funds and bond index funds for you. It also automatically becomes more conservative as you get older, shifting from mostly stocks toward more bonds as you near retirement, without you doing anything. It is the closest thing to set it and forget it investing that exists. Fee, typically 0.08% to 0.15%, slightly higher than a pure index fund, but for many beginners, the simplicity is worth the extra few cents. For a 22-year-old Sophia, opening her Roth IRA from last week's video, a target date 2065 or 2070 fund is genuinely one of the best single choices she can make. One click, done. The fund does the rest for the next 40 years. For Ben, who is comfortable picking his own mix, a total market index fund is the cleanest choice. Same outcome, just slightly more hands-on. Either path works. There is no wrong answer between these 3. The mistake is doing nothing because you can't decide. Pick any one of them, buy it, walk away. The decision matters far less than the timing, and the timing is now. The mistakes that quietly cost new investors. Let's close with the 5 mistakes that quietly cost new investors more money than almost any market crash. Avoid these, and the index fund does the rest. Don't pick individual stocks instead. The temptation, especially after watching a friend make money on a hot stock, is to copy them. Don't. For every visible winner, dozens of quiet losers don't post about it. The 85 to 90% failure rate of paid professionals applies even more harshly to amateurs. Buy the basket. Skip the lottery. Don't try to time the market. Beginners constantly say, "I'll start investing when the market dips." They don't. The market doesn't announce its bottoms. By the time it feels safe, you've missed the recovery. The right time to start is when the money is available. Exactly the lesson from our compound interest video. Don't sell when the market crashes. Markets drop sometimes. Sharply. Decades of data show that the investors who panic sell during crashes do the most damage to their long-term returns. Ben, in our story, did not even look at his account during the worst weeks. Boredom is the strategy. Letting the index fund ride through scary headlines is how it works. Don't chase last year's winner. Some index funds focus on specific sectors: tech, healthcare, energy, and one of them is always the recent star. New investors flood in after the winning run, then watch it fall back to average. Stick with broad market funds. Sector bets are stock picking with extra steps. Don't pay for what you can get for free. If a financial advisor tries to sell you their actively managed fund with a 1% fee, ask them politely to show you their fund's 10-year performance against a basic S&P 500 index fund net of all fees. Most will avoid the question. Some will be furious you asked. The polite ones might even concede. Either way, you've learned what you needed to. Avoid those 5 mistakes, and your index fund does the heavy lifting automatically for the next 4 decades. There is no advanced level to unlock. This is the level. Closing Ben isn't real, but the strategy in this video is the same one used quietly by some of the most successful investors of the last 50 years, including Warren Buffett, who has openly told his own family that when he dies, the money should go into a simple S&P 500 index fund, not a hedge fund, not a stock picker, the boring one. If the richest investor of our era is telling his family to use a simple index fund, the rest of us might want to listen. Open the account, buy the index fund, set the automatic contribution, walk away. This channel teaches you what school didn't. No gurus, no scams, no buy my course. Just the truth animated. New video every 2 days. Next week, we go deep on the credit score, what it actually is, how the 3 letters and 3 digits beside your name quietly raise or lower the price of your entire adult life, and the 5-minute habit that builds it for free. Welcome to the club.